Welcome to the GEX Private Equity Academy podcast. I'm Sri Vanamali, CEO of GEX Management, managing partner of GEX Capital, and the founder of GEX Private Equity Academy. If you are interested in learning how private equity investors evaluate businesses, assess risks, identify value creation opportunities, and make investment decisions, you're in the right place. Throughout this podcast, we will discuss a wide range of topics related to lower middle market private equity, including business evaluation, investment thesis, due diligence, transaction structuring, value creation, and real-world acquisition case studies. I will also share lessons learned from evaluating actual acquisition opportunities, common mistakes that investors make, and practical frameworks that private equity investors use to make investment decisions. My goal is to help you better understand how experienced private equity investors evaluate businesses, make investment decisions, and create value after an acquisition. Whether you're a student, finance professional, entrepreneur, independent sponsor, business owner, or simply interested in understanding how businesses are evaluated, I hope that you will find these discussions valuable. With that, let us jump into today's topic. One of the biggest mistakes I see new investors make when evaluating businesses is assuming that a good business automatically represents a good investment. And honestly, it's a mistake I see all the time. Whether I'm speaking with associates, students, entrepreneurs, or even experienced professionals evaluating acquisition opportunities, many people make that same assumption. But the reality is that a good business and a good investment are not necessarily always the same thing. When most people first evaluate a business, they naturally focus on revenue. How big is the company? How fast is it growing? Is it in an attractive industry? Does it have a recognizable brand? Those are all reasonable questions, but private equity investors tend to evaluate opportunities differently. We are not simply trying to identify good businesses. We are trying to identify investments that can generate attractive risk-adjusted returns. And that is a very important distinction. Over the years, I've evaluated businesses with outstanding management teams, strong revenue growth, loyal customers, and excellent reputations. On the surface, they look like fantastic businesses. But after digging deeper, they were not opportunities that I wanted to pursue further. And why is that? Because the risks outweighed the potential returns. Sometimes there was significant customer concentration. Sometimes the purchase price was simply too high. Sometimes growth opportunities were limited. Sometimes there were operational challenges that were not immediately obvious. On the other hand, I've also evaluated businesses that were not perfect. Maybe they had inefficient processes. Maybe they needed better systems. Maybe there were opportunities to professionalize the organization. But if those issues were fixable, those businesses often represented very attractive investment opportunities. And that is one of the things that makes private equity so exciting. We are not simply buying businesses. We are evaluating the relationship between risk and return. We're asking what this business could become over the next 3, 5, or even 10 years. One thing I often tell my associates is that investors are buying future cash flows. They're not buying historical revenue. Historical financial statements tell us what happened. Investors are trying to determine what happens next. And that is why when evaluating an acquisition opportunity, we ask a much broader set of questions. Is the industry growing? Are there favorable long-term trends? Are there barriers to entry? How diversified is the customer base? Are revenues recurring? What differentiates the company from its competitors? How dependent is the business on a small number of customers, suppliers, or employees? Can management execute a value creation plan? Can the organization support future growth? And of course, we evaluate the financials. Revenue matters, EBITDA matters, cash flows matter. But those numbers only tell part of the story. What really matters is understanding the quality and sustainability of those earnings. Another thing that I've noticed over the years is that new investors tend to focus heavily on the upside. They get excited about growth. They get excited about projections. They get excited about future opportunities. Experienced investors certainly care about the upside, but they spend just as much time evaluating the downside. What could go wrong? What assumptions need to be true? What risks exist beneath the surface? How resilient is the business if the market conditions change? Those questions often determine whether an investment succeeds or fails. Let me leave you with a very simple example. Imagine two companies. Each generate $10 million of revenue. Each generate $2 million of EBITDA. On paper, they appear almost identical. Company A has hundreds of customers, recurring revenue, stable margins, and predictable earnings. But company B has one customer representing 30% of revenue, project-based revenue model, and a highly volatile earnings. Would private equity investors value those businesses the same way? Probably not, because risk matters. And that is really the key takeaway from today's discussion. The biggest mistake that new investors make is assuming that business quality and investment attractiveness are exactly the same thing. They're related, but they're not identical. Private equity investors evaluate opportunities by balancing growth, risk, cash flow, valuation, management quality, and value creation potential. The objective is not simply to identify great businesses. The objective is to identify opportunities that can generate attractive risk-adjusted returns. And that is one of the core concepts that we will continue exploring throughout this podcast as we discuss how private equity investors evaluate lower middle market acquisition opportunities. Thank you for joining me for this episode of the GEX Private Equity Academy podcast. If you would like to continue learning how private equity investors evaluate real lower middle market acquisition opportunities, I invite you to join the GEX Private Equity Academy Insider List. As an Insider List member, you will receive our complimentary private equity starter kit, transaction insights, educational resources, and invitations to select live private equity case study sessions. If you found this episode valuable, I would also appreciate if you subscribe to the GEX Private Equity Academy YouTube channel so you do not miss future podcast episodes, acquisition case studies, and other educational content. To learn more or to join the insider list, visit www.gexprivateequityacademy.com. Thank you again for joining me. Until next time, keep asking better questions, keep evaluating opportunities, and remember, do not just look for great businesses. Look for great investment opportunities. Thank you.